I use an analogy in terms of coffee. It's not a strong Colombian bear market. It's a decaffeinated bear market where yields on the 10-year probably rise by 10 to 20 to 30 basis points for the year. But nonetheless, it means that yields are probably moving higher as opposed to lower, which they have been for the bulk of the 25-year period that you cite. Now, what do I see that presents that possibility? First of all, I see nominal growth in the United States increasing from where it's been at 4% for the last 4 or 5 years to maybe 5% due to tax cuts and an increasing deficit. I see the U.S. Treasury, and this is interesting. I haven't heard this yet on newswires, increasing from a $500 billion net issuance to a $1 trillion net issuance in 2018, primarily because of the deficit. And I see central banks, not just the Fed, but central banks cutting back on their quantitative easing. The ECB is cutting theirs in half, and by the end of the year may entirely eliminate it. And so the flush of money is being met with a flush of supply, and that produces higher interest rates.
Well, you've got two reasons also that rates would go up, and I'm oversimplifying it, Bill. I understand that, but here they are. I mean, you got the sort of the economic story, right? To your point, things are kind of humming along. Maybe the Fed gets involved, or you've got selling pressure. And I know that you have said that you believe today that you were seeing some evidence that China was selling or even dumping U.S. Treasuries. So what is the cause of this backup in yields?
Well, China, I believe, they're not liquidating treasuries. They've got a huge portfolio in the trillion-plus area, but they are trying to diversify their portfolio, and that means more gilts, that means more bunds, that means more Spanish bonos. And so, central banks and the Chinese central bank and the Chinese fiscal authority, are probably in the area of reducing their commitment that they have for the past 3 or 4 years. And that commitment's been huge. Brian, over the past 5 years, quantitative easing in total from all these central banks has been about $14 trillion. And so if we posit that in September or October that much of this it doesn't go away, but it stops increasing, then the pressure for slightly higher yields is probably with us.
So, Bill Tyler here, how much you say this bear market may be not a robusto, but something a little more calm than that. But how much is it going to hurt, Daddy? I mean, what am I going to do with my bond fund shares that I've been shoveling money into?
Well, that's a good question. And last year and the year before, the 10-year Treasury bottomed, as Rick Santelli accurately points out, in June of 2016 at 145, and so theoretically 255 would have produced a significant bear market. But with high yield bonds adding to the pot, bond investors have basically been satisfied with a 4 to 5% annual return, and they haven't seen or felt a bear bond market. Now with high yield spreads so compressed, I don't think there's much room for further capital gains, and with yields where they are, I think bonds produce a return of 0 to 1%. And is that a bear market?